For reaction to Macklem's comments today, let's bring in Jimmy Jean, Vice President and Chief Economist and Strategist at Desjardins. Thanks so much for joining us this afternoon, Jimmy.
Thanks for having me.
So what do you make of Macklem's comments, in particular when he said interest rates may now be restrictive enough to get us back to price stability? It sounds like he's saying interest rates have peaked. We've hit the peak.
That's right. I think he's sounding the most constructive we've heard of him in a while. And I think the context of this speech says a lot for two reasons. The first is that it comes right on the heels of the fairly encouraging inflation report we had yesterday. And then secondly, it comes less than 24 hours after the fiscal update, which did raise some questions as to whether it met the governor's plea for governments to row in the same direction. I think his tone today signals that he's not overly concerned about the spending. And it's also important to highlight that a lot of the announcements involve sums of money that will be spent over a fairly lengthy time horizon. That's very different than the sort of sugar rush types of expenditures we used to see during the pandemic. So I think that all speaks to a Bank of Canada that is growing confident that the tightening is working as intended. Growth has flatlined, the slack is opening, the job market is loosening, and that is all quite consistent with what we were forecasting a year ago, despite the strong demographic growth. When you look ahead, even, when you see inflation cooling and the Bank of Canada not cutting rates right away, what it means is that the real interest rates are actually getting more restrictive. And on top of that, you have the balance sheet reduction that works in the background. So, all of this together means that they're fairly restrictive indeed. And that's why we think it would actually be irresponsible for the Bank of Canada not to start calibrating this amount of tightening into 2024. And that's why we've been consistent in expecting the bank to cut interest rates starting next spring.
Jimmy, do you think it is more than a coincidence that this speech is happening the day after the federal fiscal update, so that the Bank of Canada knows what the federal government was planning in terms of its spending, or so that the federal government didn't get ahead of itself if the Bank of Canada put this out there that interest rates were at their peak, and you would think the next step would be perhaps interest rates would be cutting down the road and maybe get ahead of things there?
No, I don't think there's any coincidence. I think, in the broad scheme of things, if you look at the Bank of Canada's forecast, they have been forecasting government spending to grow ahead of potential. And I don't think anything that's been announced yesterday changes that broad picture. So for them to come ahead and said that perhaps interest rates have peaked suggests that they've taken the information on board, but they're still confident that they've put enough restriction, and they've put quite a lot. Remember, Canada started this hiking cycle with debt to GDP at 178%. I don't think there's a lot of other advanced economies that have debt so high and with renewing terms on mortgages. So, the pain is there to be seen in the data. And I think what they've seen in terms of the reaction in the economy to this tightening is reassuring them, hence why they're sounding more confident today.
So how long do you think the Bank of Canada stays at these levels with rates?
I think, as I said, the more we see inflation cooling and therefore inflation expectations going down, it means that, when they're not moving, they're actually being more restrictive. Real interest rates are getting higher. So I think, they can sit it out a few more months. I think by April, they'll have collected a sufficient body of evidence. By then we'll have inflation presumably more around 3%. And they also know that there's an important shelter component that's pressuring inflation. They'll be looking as to whether a core services excluding shelter is continuing to decelerate. And if they've seen sufficiently compelling evidence on that front, they'll be ready to start cutting. Not cutting in very rapidly, but starting to cutting progressively to loosen up some of the pressure that they will be exacerbating if they keep interest rates unchanged.
Yeah, Jimmy, we've actually got a graph of yours from one of your recent reports on that, stripping out, looking at core inflation and also stripping out shelter as well. And your forecasts for that, it actually looks like you have inflation below 2% through next year.
That's right. We think and it's been certainly the trend in the last few months. We think it will continue. And at some point, yes, inflation in that very important category, which is the category of spending that the Bank of Canada's actions has more influence over. So we think will be, somewhere between 0 and 1% over the next year. And that will be producing that pattern whereby overall inflation will be converging towards target. Again, and I think it's something that Macklem said in his last press conference. They don't need inflation to be at 2% before starting. I think when they see overall inflation is at 3% and understanding the underlying dynamics, they'll be ready to start cutting interest rates.
When that cutting happens, do you think that the Bank of Canada will be moving to do that before we see the U.S. Federal Reserve doing the same thing?
Yes, I do think so. There's no doubt that the Canadian economy is more sensitive to interest rates than the U.S. economy is. You just look at how GDP has been pretty much flat, again, despite, demographic growth in a scale that we haven't seen in many decades. That speaks volumes to how biting this interest rate cycle has been and will continue to be, as we know that only half of mortgage holders will have renewed by the end of this year. So, I think the Bank of Canada will be very comfortable to start loosening up on that front before the Fed will. I think the U.S. has a lot of resilience. It's seeing inflation cooling as well, but the labor market remains pretty tight. Here we've seen the unemployment rate go up by as much as 0.7 percentage points since the low. And certainly with the strong population expansion, it means that the pressure is going to be upwards on that front. So that will be even further compelling for the Bank of Canada to really start to cut interest rates.